Yeah, thanks for joining us.
No problem. Where are you guys based?
Washington, D.C., just north of D.C. in Frederick, Maryland.
Oh, cool.
So, I don't know. How about yourself?
So we're based in Mountain View, California. It's
Yep.
It's like a stone's throw from the Google and the Apple headquarters.
So, any relationship
Do you actually
with
throw stones over there?
I'm sorry?
Do you actually throw stones at them?
Funny, a lot of people actually do. Because some of us used to work there, so we don't throw them at them anymore, I guess.
It's true.
Sure.
It's your old friends.
And I have to ask before we start: are you related to Felix Feng?
No. It's actually funny because a lot of people ask me that because like Feng's actually not a very common not a common like surname, but yeah, it's just I'm sure we have some distant.
Well, I know you two Fangs who are in like very related industries.
Yeah, that's true.
So it's no, but so I guess you can see we started recording.
Okay, sure. But funny if I've gotten to know Felix pretty well over the last few months, so he's a good guy. So it's probably
there's no rivalry happening.
No, not at all. I mean, because it's a small industry. I think that actually one of the experiences that I kind of took away from having done startups in the past is, in the very beginning, like competition doesn't really matter. It's more like, because everyone changes, everyone pivots into stuff, and what really matters is kind of like how do you expand the market rather than how do you kind of like duke it out with the other folks trying to do the same thing.
Right, like even if you get 100% market share at the current moment, you're probably not a sustainable business. So
yeah, exactly. Yeah, exactly.
You really just have to grow it.
Yeah. So for you guys, because I saw some posts you guys did on Medium recently. How did you get into crypto? And
yeah, I mean, for me personally, so I used to work at the CFTC. That was sort of how I got into derivatives, which is the Daxia piece. So more on the regulatory side, and then before that, I was actually doing some bot trading for crypto on my own. So I have a lot of questions for you now that you're kind of into the whole bot trading crypto scene. So yeah, like I'd just been in crypto for a long time, just trading it, and I had the opportunity once I got to the CFTC to move into derivatives on top of it, and especially regulations regarding derivatives and crypto. So,
and I was consulting a small startup in 2013 that they were like a small Bitcoin startup, and they asked if I could accept Bitcoin as payment, and I really had no idea what it was at the time, and I said, well, okay, and I ended up auto transferring most of that into dollars because it was like a major paycheck. I needed to pay the bills, but I ended up keeping some of them, and starting to pay attention as the price, like this was right around the time where it started to get interesting price wise. Right. So I was like, I should probably learn about this Bitcoin thing, and long story short, here I am.
How about yourself? So are you a former Silicon Valley guy out there?
Yeah, sort of, I guess. So I started my career as an investment banker. I used to structure collateralized debt obligations at Citigroup and JP Morgan. And I did it for quite a long time, actually. So I started in 2001. So when most people hadn't heard of CDOs or other acronyms.
Sure.
I focused on the ones that were backed by subprime mortgages and other residential real estate risk. So for better or for worse, I had a hand in a lot of the sort of like the more infamous securitizations that kind of like contributed to the 2008 financial crisis, including like the Bear Stearns asset management deals and a few other issuers. So I kind of like made my way to the Valley because I was just really sick of like working on stuff that wasn't really contributing to kind of like what I saw as like being value additive. And I was really disillusioned after that whole crisis because I felt that I had spent a large part of my career, you know, subtracting value from the world, so to speak. And I just really wanted to do something that was more engineering related, because what drew me into that area was kind of like using math, statistics, and financial engineering to create products that were more optimal than what previously existed. But you know, the opposite basically happened. And so, I was just really disillusioned. I was working in Hong Kong at the time. This is like 2010, and I was like, you know what? Screw this. I'm gonna just like leave finance altogether. Never do anything related to finance again, and just do something in tech instead. So, I was fortunate enough to get into an engineering master's program at Stanford. Kind of made a career switch into engineering and tech from traditional investment banking. So I kind of like did that. I started a company. We use computer vision to extract tables and other structured objects from PDF files. So it's called DocsIQ. And eventually DocsIQ was acquired by another PDF company called Nitro, where I led product until kind of like finding my way into crypto in early part of last year.
Nice.
But I think for me, I think I was always really interested in smart contracts. I remember 2013, my former co-founder and one of our engineers was like, "Hey, you gotta pay attention to this Bitcoin thing. It's the price is like gone up to like 35 now." So I remember looking at the screens, and I was like, "This is a complete scam. What's the point of this? It's magical internet money." And I was really very bullish. I was very bearish on it. In fact, I think there's a post on my Facebook feed from like late 2013 when the price had like gone up to like a couple hundred and spiked back down to like 50 again. And I'm like, how do I find a way to short this thing?
Right.
And but it wasn't until the Ethereum white paper came out and started reading it, and I just felt that smart contracts and the ability to put financial products like derivatives, loans and everything else on the blockchain would make for a much more efficient, transparent, and an open system. And especially because from having gone through the crisis myself, one of the things that exacerbated the crisis was the fact that no one knew what their exposure to Lehman Brothers truly was. Every credit default swap, as you guys probably know, is basically just a bi-party, an agreement between two parties. And so when you have, all of these like agreements out there, and no one can trace exactly, which parties have ultimate exposure to a large entity that blew up like Lehman, basically the whole financial world was frozen for a 3-month period starting in about August of 2017.
Yeah,
So,
no, I mean, I remember there was an article last August, I think it was like, it was in the Wall Street Journal, like, oh, derivatives of Lehman are finally settled. And it was like a decade later,
Yeah. And I mean, because I structured all these things and I'm like, they're actually pretty standardized. It's, it's like, sure, you have like the ISDA master agreement and the credit support annex, but most of the time, the logic itself is like a 1-page, confirmation, which listed like the basic terms. And so what really got me to crypto was the belief that eventually smart contracts would replace these paper contracts, and we would be in a much more efficient and transparent world. So that's kind of how we started CoinAlpha. The middle of last year. I was fortunate enough to link up with my friend Carlo, who had kind of taken a similar path as me. We had gone to college together. He also, spent a lot of time structuring derivatives, and now he had kind of like done a tech startup in Asia. And our other friend Martin, who was another startup founder. Got a job at Apple as a pretty senior machine learning engineer, but his passion was trading Bitcoin. So in his spare time, he applied some of his engineering and machine learning experience to build a bot that would, try to predict where the price of Bitcoin and Ethereum went and execute trades automatically based on that. So kind of like because like Martin already had a strategy in place, and we felt that funds were a good kind of area to tackle because funds are ultimately extremely opaque. They're very inefficient, and small fund managers have a really tough time because the fixed operating costs of running a fund are so high that you basically need like $10 million in capital before you're even like solvent as a fund manager. So we felt that using smart contracts would allow almost anyone, like even if you only had like a few $1,000s, to create a vehicle that would allow you to sort of like earn management fees from leveraging your expertise.
And this is what CoinAlpha was supposed to.
Yeah. So that was the first thing we did. So we have a protocol for essentially a blockchain-based hedge fund. It's called the Fund Protocol. It's on our GitHub. But we also felt that it would be hard to just like to ask people to use it if we didn't know exactly if it would work and what the what the complication.
Sure.
So we also want to essentially create the first application that use that protocol. So we created a hedge fund called CoinAlpha Falcon. That it kind of went through all the hoops, registered it with the SEC, and we have a PPM and an LP agreement, and all the kind of nuts and bolts of a regular hedge fund. But the tweak is that rather than having a traditional administrator and a traditional auditor, instead we use our smart contract to fulfill those functions.
Nice. And
so yeah, and I think I guess like we are seeing. I guess it was one of the first like tokenized funds.
Besides the DAO, right?
Yeah, besides the DAO, but we tried not to market it as such because we weren't letting in retail investors. We weren't allowing people to transfer the shares freely, and so we felt that like calling a tokenized fund would attract like the wrong types of people. So we just called it a blockchain-based fund and try to market the fact that the advantage of having a blockchain was that you got like, because it wasn't a human administrator standing in the way of all operations, we were able to have a really low minimum investment. I think it was like 5 Ether. And we offered people daily liquidity. So, anyone who was, in the fund could issue like a subscription request or redemption request, and it would get filled the next business day, because it was all through the smart contract. And so we felt that the advantage of tokenization is really kind of like in cutting out the middleman and gaining the operational efficiencies from doing that. But just because you have a token, like, doesn't mean that it's quote more valuable.
Yeah, no, I couldn't agree more. And we can just jump right into it then. Obviously the SEC did not agree with maybe your initial view of what you were. Where do you think you make?
So that was pretty interesting. Yeah. So I mean, I think that I would say that one of the things that one of the lessons we learned is that when you're doing something in finance, like taking a move fast and break things kind of attitude, which is kind of like what we learned from creating other tech startups in the past, is probably not advisable. In our case, we never intended to kind of to market the fund to retail investors. We had a lot of information on our website, on blog posts, and with media interviews, because from our perspective, we were marketing the technology. We wanted this template of a blockchain-based fund to be something that other fund managers would understand and adopt. And so, like, we felt that the fund ourselves, we weren't really marketing it, but of course, we did have a contact form on our website, and we did talk about the fund in various posts and media interviews. When we were contacted by the SEC initially, we think it's because obviously we were a company with the word coin in it. We did have a fund vehicle, and so one difference between what we were doing and what other kind of like quote ICOs are doing is that we utilized an exemption under the 33 Act called 506B, which means that you can market, but you cannot do what's called general solicitation. Most of the other ICO issuers tend to use an exemption called 506C, which does allow for general solicitation, but you have to verify that each investor is actually accredited. We use a 506B exemption because, frankly, that's what all startups and hedge funds use. I think that, like, from our standpoint, we didn't didn't fully grasp all the general solicitation nuances.
And that's sort of what they got you guys on, or that was their issue with you, was on the general solicitation piece?
Exactly. So because just taking a step back, I think one of the main concerns with the SEC, and rightfully so, is are retail investors who don't understand what they're investing into, buying into these things that they don't understand, and which they shouldn't be in. And so and I think that's a concern generally in looking at all the companies out there. So in our case, I think we're not exactly sure kind of what got us on the radar, but we think it's because they thought we did an ICO. So we met with them and explained what happened, and frankly, it was actually really good working with them because I think they were quite interested in what we're doing in terms of technology. However, I think they did believe that they had a case in terms of general solicitation, and given how that rule is defined,
or not defined.
Yeah, it's quite broad, and so from our standpoint, we felt that kind of like a technical kind of type of settlement was the best way to close the matter and to focus on managing our business rather than trying to litigate the issue. But overall, from our standpoint, we felt that the main lesson we've learned from that whole experience is that the crypto industry is under a lot of scrutiny from regulators, and no matter how small you are or how good your intentions are, I think it makes sense to to pay closer attention and to try to comply with the highest level of regulatory guidance out there, rather than kind of like assume that you're going to fly under the radar because you're small. And so I think that a lot of the I'm sorry, go ahead. I didn't mean to ramble on.
No, please finish your point. No, it was good. I'll jump in a second.
Okay, so I think the only other thing we learned is that I think even though a lot of funds and startups in the past have utilized the 506B exemption, we actually ended up kind of fulfilling the 506C exemption by verifying that all of our investors, were accredited. And it turns out that because of the infrastructure built out to service ICOs, that process from both the issuer standpoint and also the investor standpoint is much easier. And so, I mean, like our advice for any kind of like fund or crypto startup that's looking to raise capital is, rather than kind of like, relying upon the 506B exemption, just do a little bit more work. Verify that all your investors are accredited if you're going to kind of like, issue a private placement. And so, and that basically allows you to actually market and be open about what you're doing, rather than kind of having to kind of to manage around the general solicitation guidelines.
Awesome. That's really awesome information. Thanks for sharing that experience. In addition to what you learned from that, probably most people watching this haven't had the experience of being under the scrutiny of the SEC or having a disagreement with them. Like, what was that like from like the human drama standpoint? Like, did they call you up? Did you get like a black envelope in the mail with,
So we got a letter in the mail. So we got a letter in the mail. Our lawyers are with Orrick, Harrington, and Sutcliffe. So they have a lot of experience kind of dealing with these issues. So a lot of this we basically just kind of worked through them. So most of the conversations that happened were between our lawyers and the SEC. The process was fairly long, mainly because like we've heard that they're working on a lot of cases. So there's apparently hundreds in the works. But the process is actually pretty straightforward. We did fly to DC, we met with them, and we explained to them what we're doing. We provided them with basically every bit of information they asked for, and then kind of like and our lawyers kind of basically negotiated with them throughout the process. But overall, I think that
it doesn't
in
sound
our
like
view,
you were really too worried, from the way you're telling it.
Well, I mean, I would say, I mean, I would say we knew that I guess in our view hadn't kind of like really done anything wrong. And so for us, it was more about kind of like explaining what we hadn't done, and just kind of essentially, providing the information necessary to get them to that same place. And also, I think with respect to general station, we felt that, it was like whether we had done it or not, it was easier just to kind of like, reach a settlement and close our fund and move on. Because I think even when we were talking to the SEC, we had realized that this initial direction of creating blockchain-based funds was probably a bit too early for the market. And so we had already kind of like changed direction. And so it was already just something that it was a more of a natural outcome to close it out.
Did you see it as too early for the market or too early for the regulators?
Yeah, it's actually too early for the market. This is actually pretty interesting because I'm really glad that we created a fund and just try to make it happen, because one of the things we learned is that, while it works in theory, we had a lot of trouble getting other fund managers to adopt our template. And even ourselves, we ran into issues just keeping accounts open at different cryptocurrency exchanges and attracting institutional investors, because they all wanted that rubber stamp of a third-party administrator. So when we said, "Hey, we're doing this via smart contract," it just made things a lot harder. Similarly, I remember speaking about our model to a traditional equity long-short hedge fund manager. And he said, this is really interesting. I wish like I could use it to save on administrator fees. But if I told my LPs, who are traditional pension funds and endowments, that, we were trying to optimize fund structure using a smart contract, they would probably redeem, because they would feel like we're not spending time on what really matters to them, which is strategy and performance, and not trying to make the fund more efficient.
And you're like, this is making it so you can spend more time on that.
Yeah, exactly. Yeah. And so I think that, to be honest, like we definitely struggled to, really capture the hearts and minds of fund managers and get them to use it. Like we actually do have a few fund managers using our protocol today, but they're more like very small fund managers, like, individuals who are trying to start something. And so we still support them in using our open source protocol, but we felt that it would be hard to take that model and really make it scale with larger funds.
Sure. No, that's sort of kind of goes into my next question, which would be like, so you guys, your model's like, I guess, a little bit different than the pure DAO models of the past. It's how much does, I guess, the blockchain make sense in where you are still essentially a third party. You're just using the blockchain to maybe make things more efficient versus being decentralized.
That's right. Yeah. So I think this also stems, ultimately, I think that the idea of a truly decentralized fund has merits in certain areas, but I think if you look at like why people seek professional asset management, is because they want an expert to define a strategy. And so having kind of like lots of players involved is almost the antithesis of that need. And so I think we've always felt that the actual strategy itself should be defined by a professional. So in our case, we used historical price and volume data to train a machine learning based model that would try to predict the mean change in variance of Bitcoin prices over a 1-day period. And so a lot of the work we had done is basically in fine tuning that model and trying to make sure that it doesn't overfit. So that piece was totally centralized, totally off chain.
Yep.
And basically we ran both the modeling, the back testing, and the trade execution via our own proprietary AWS based stack. The part that we put on chain was simply the what I call the fund administration piece, which is the accepting capital from investors, redeeming capital to investors, and calculating the net asset value, which is basically the value on a per share basis after deducting for fees and other things like that, given the performance of the portfolio. And so we essentially had a server that pulled in the value of the portfolio from the cryptocurrency exchanges where we traded on a daily basis, and then the smart contract uses Oracle to access that value, and then the logic in terms of how the fees are calculated and how the NAV was calculated was encapsulated in the smart contract.
Cool.
And then investors had to invest and redeem using Ether rather than dollars.
And did you have trouble getting people to invest using Ether? I know that's always a big.
Yeah. So actually, that part was not the roadblock.
Really?
So it turns out that the people who this model is good for are retail, because not exactly retail, but I guess small credit investors.
Obviously accredited. We've learned our lesson.
Yeah, obviously accredited. So most of our investors were they were like product managers at Facebook or startup founders and other people like that who, while they met the threshold of being an accredited investor, they didn't have like $250,000 to invest into Polychain or Metastable or some of the other large funds. And so what they were attracted by was the fact that they could invest like $10,000 into a quant-based crypto strategy. And for them, because they were already Coinbase holders or people like that, investing using Ether was a fairly straightforward process. However, that's really hard to scale because one of the regulations that applies is the Investment Company Act of 1940, which states that you can have only up to 99 investors in a private placement. And so, if you kind of do the math and you figure you take like everyone's like, let's say $25,000 average investment, if the max number of people you can have is 100, that really caps the size of your fund. And so that was another kind of like legal issue that prevented us from focusing on retail investors exclusively and trying to build funds based on them.
Right. Yeah. No, I know a lot of projects in the space. It's still these, UX sort of issues of getting people in. But since you could kind of get people to give you Ether from a centralized exchange, it's almost easier than dealing like with the whole DApp scene. And
yeah. We did have to educate people on how to use MetaMask because they couldn't just send it from Coinbase. Still had a like 7 Ethereum wallet and send it in. But overall, because the investment process was like that process was simpler than the accredited investor verification and KYC and all the documentation really up to it. So the MetaMask part was actually kind of like smaller point of friction than the others involved in investing in funds.
Sure. I guess what do you think that says about the space in general? Like you hear a lot of times like, well, the space has a giant UX or scalability problem. But I mean, from your perspective, it sounds more like it's a regulatory problem or getting people educated on that.
Yeah, like an educational problem.
I think it depends on the user base you're targeting, because like one advantage that we have is that we can afford to handhold users throughout the process because each of our investors were investing like $5,000-$10,000 a chunk. So it made sense to essentially handhold each of them through the process. And once they're in, they kind of understood and they were able to see the advantage in doing so. I think that the UX problem is more pervasive if you're looking at like more mainstream type of applications where you need, let's say, people in a third world country to mass adopt a product. It's much harder you can't just kind of go and handhold each of them and walk them through the onboarding process. So I think that there definitely exists a UX problem in crypto. For instance, even for most people, if you have your capital locked up in a hardware wallet or on a centralized exchange, and someone comes out with a mobile app that uses cryptocurrencies, like just actually using that mobile app is kind of a challenge, because most people aren't using Coinbase Wallet or other mobile apps yet. However, that is changing a bit now. But overall, my belief is that the US applications, I think, are much more of an impediment if you're targeting kind of like the mainstream non-crypto users. However, applications that target like a more specialized set, like accredited investors or crypto traders, for example, shouldn't really face that problem. And it's a bit of a cop out to say that UI UX is a cop out for those specialized applications.
Sure. And I guess that's a great lead in to your next product, which is HummingBot.
So I think that to be perfectly honest, I think once we kind of revisited our game plan, the second part of last year, I think we realized that a lot of the value that we had created wasn't necessarily in kind of like our ability to create and write smart contracts, because that's a relatively fungible skill now. Basically, anyone who understands JavaScript should be able to write a smart contract. However, creating a robust, performant, and reliable trading bot that can access multiple exchanges like the ones we had created was much harder. In fact, I would say most of our engineering over the past kind of year and a half has really been focused there, because even though exchanges have APIs, they're all kind of different. They all have like these weird edge cases, like rate limits, error conditions they have to handle. And in addition, I think while we initially built our stack on Python, we realized, after a while that it was just too slow. So we converted everything to Python, which is basically, you still write essentially Python-like code, but it compiles into low-level C. So it made our infrastructure about 1,000 times faster than where it was previously.
Cool. So HummingBot, I guess for those that haven't looked it up yet, it's basically just almost like a hedge fund where you invest in this bot that then trades on your behalf.
So I actually would equate it more to like kind of like a Bitcoin mining node. So mining nodes are just software clients that are run either locally or in the cloud, and they perform essentially an algorithm that allows users to profit. So there are a bunch of parameters you have to set for a mining node to actually make it run well. Like for instance, you have to pick which coin you're looking to mine, and change other algorithms like that are involved. And so similarly, HummingBot is a software client run locally or in the cloud that uses a user's like token inventory to make a market in that token. And so market making is basically saying, I'm willing to buy this asset for a price of X plus 1%, and I'm going to sell it for X plus 1% and buy it for X minus 1%. So that role in traditional markets has been the exclusive province of quant hedge funds, high frequency trading shops, and other very specialized organizations, because in fiat markets, only those firms can access the exchange directly.
Right.
However, in crypto, we have direct market access. Both individuals and funds are on a level playing field because they're accessing the same APIs. And while crypto exchanges, we think some of them will, kind of like provide services like co-location that cater exclusively to funds. The competitive nature of crypto exchanges currently means that exchanges almost have to be open with their APIs in order to compete with one another. And so that opens up the possibility for anyone to run essentially a market-making bot and profit from earning the bid-ask spread that exists on different cryptocurrency exchanges.
Well, so I have to ask, so I did this for a while, do you see it getting harder to make money,
Yes.
As like more of the virtues and the jumps and the traditional players get on board?
Yeah. Yes and no. I think it's definitely. I think there's like a kind of like a bit of like a long tail element here, because so what happens is on a large centralized exchange like Coinbase, and for the top trading pairs like Bitcoin to dollar, for example, it's really hard for a small market maker to compete, because there's a lot of volume there, and that's where the folks like Jump, Virtu, Renaissance, and Susquehanna are playing. However, once you start going to smaller token pairs and small exchanges, that liquidity diminishes significantly. And so if you look at kind of like from someone like Virtu's perspective, these have a balance sheet of over $1 billion. So for them to allocate the resources to trade very small token pairs in less liquid exchanges simply isn't worthwhile when they can focus their efforts on larger volume, higher liquidity token pairs and exchanges. So we feel like the ability to provide to earn that bid ask and to provide that market making service, especially for the smaller token pairs and small exchanges, is actually individuals and small firms are better suited to that than large firms. And so this kind of dynamic already plays out in stock markets. So one of the things that is happening right now in stock markets is because of the fragmentation of different exchanges. Now there's like 13 different dark pools, ATSs, and exchanges in the US. That fragmentation of liquidity has caused small cap stocks to suffer from lack of attention by market makers. Market makers are, it's almost like if you can market make for Apple, why are you bothering with some small penny stock that is trading on a different exchange? And so that same phenomenon is happening in crypto, but even more so because instead of dozens of exchanges, there are hundreds, if not thousands, of exchanges around the world, and each one has dozens to hundreds of token pairs.
Sure. Yeah. I mean, how would you? The one thing I hear, you're obviously taking these machine learning algorithms and training them on historical data. Mm-hmm. How well does that work? Looking back at a time frame, because can you say that the last 6 months of Bitcoin prices were similar to the previous 6 months?
Yep. Yeah. So interestingly, initially we're not really using machine learning at all. Okay. So I think people tend to, I would say, over-index on the mystique of machine learning or AI. It's just math and statistics. So all of us have learned linear regression in college, and that's all machine learning is. It's just you're just taking more data and applying more sophisticated types of regression onto the data. So initially, we're not using that at all. All we're doing is making available a trading execution client that allows someone to make a market. And more specifically, we're focusing on a strategy that we think is lower risk for new users. And that strategy is essentially what we call cross-exchange market making.
So ARB opportunities, basically?
Sort of, yeah. So it's not exactly true ARB because, you know, so we kind of define arbitrage. An arbitrage strategy is one where, you know, the bid-ask spread on multiple exchanges cross, which means that the ask price is lower than the bid price on another exchange, and therefore you can take the you can basically buy low and sell high on two different exchanges and kind of essentially and really clip a true arbitrage profit. In cross-exchange market making, you don't need the bid-ask spread across. Instead, you simply need one exchange to be wider than another exchange. And so what that allows you to do is you can make a market on the wider exchange. And if your orders are filled on either side, you can automatically conduct an offsetting trade on the tighter exchange and clip that arbitrage profit. So it still is more or less arbitrage, but instead of being like a taker-taker arbitrage, it's more like a maker-taker arbitrage. And so those opportunities exist more. And on top of that, there's also, I think, a benefit here because what you're really doing is you're porting liquidity from a more liquid venue to a less liquid venue. So there also are benefits for the exchange itself because, you know, and so this is also why we focus initially on decentralized exchanges, because we believe that decentralized exchanges will be the future. They offer a lot of benefits, particularly from a security perspective for users, but what's preventing them from, you know, being widely adopted is basically the liquidity challenge. Unless you have tight bid-ask spreads, you know, high volumes, traders simply, you know, aren't going to trade there. And so by optimizing HummingBot to help decentralized exchanges get liquidity, we believe that we're also allowing them to overcome that cold start problem and get more adoption.
So basically, you'll be on the DEXs and providing a nice wide bid-ask spread.
Tighter, I guess, tighter bid-ask.
Slightly tighter than they are now, but not quite as tight as the decentralized guys.
So we believe that there will be, because of the arbitrage-like nature of cross-exchange market making, essentially, any time that you can kind of essentially replicate the order book from a centralized exchange onto a DEX and have a slightly higher amount of bid ask, the market maker should be able to profit. So we believe that at scale, HummingBot will allow any DEX to have the same liquidity as the most liquid decentralized exchanges.
Sure.
Because anytime there's a bit of a difference, market makers will earn arbitrage spread.
Well, this is always one of those things, you know, like if you like write it down on paper and then it's like, well, theoretically it should lead to this, but then it hasn't gone there quite yet, you know, so we're hoping that it can take some time.
Yeah. So, and we do recognize it's an experiment. No one's ever created a open source market making, bot of this nature before, primarily because most quant funds and other professional trading firms are very secretive, and every bit of their IP they produce, they want to keep in-house. But from our standpoint, you know, we view ourselves as primarily software manufacturers, and we think there's an opportunity here to kind of take a closed model, open it up, and
well, that's always the question with, you know, trading bots. Like, why would you, if you can trade it yourself and make money, why would you give it away to anyone else? You know?
Yeah, and so the reason that we're comfortable doing this is because the actual algorithm itself is very straightforward. It's simply buy low and sell high. The hard part is actually doing that on automatic, automatically quickly. But also to do this, you also need inventory, right? So to do cross-exchange market making, you need to maintain inventory on both the wider exchange and the tighter exchange. And so, and in that particular token pair. So, you know, if you look at like all the exchanges out there, all the token pairs, is essentially a huge graph of nodes that we're connecting via via HummingBot. But there's almost like an infinite number of combinations out there. To really take advantage of this opportunity, you need to actually have inventory. And so from our standpoint, we think that it will be more effective for us to release software and allow users to use their own inventory than to just, have a closed source software product that we run ourselves without a limited amount of capital.
Sure.
So how much does the user have to know about this opportunity and these strategies
Yep.
to be able to
Yep.
to do? Is it how much of it's automated? How much handholding you have to do?
Yep. That's a great question. So, we've done a lot of research into other open source trading bots out there. I think we can improve, on kind of like some of what they've done before from the UX standpoint. However, the first versions of our bot, they are optimized for, people with some trading experience, some development experience. But over time, we hope to make it much more user-friendly, by adding user interface and allowing kind of like almost like the average person with cryptocurrencies to use it. But in the very beginning, we are optimizing for a bit more of a power user persona.
Gotcha.
Where they can go download the Python code. And...
Yeah, exactly. Yeah, so where people who can, kind of like install Python and set parameters and do other things that
right
would allow them to run it effectively. So we're running we have a private alpha program with a few kind of like crypto funds, quants, and other individual traders. But over time, we do hope to have something that almost anyone can run.
Yeah, so I think you had already talked.
I'm not the power user.
But I guess you had talked that the DEXs are the future of the space in general. A lot of people have been saying that DEXs are sort of you can front run them, and there's still some security issues for making them work to their full extent. Do you guys work on those or?
So I think, to be honest, I think the front running concern is a bit overblown, because like if you think about it, like basically what that means is that if you see a transaction that happens on the chain which hasn't been confirmed, you can pay more gas and take that order and kind of crowd out the maker that kind of like whose original order was, or the taker that is. So I've talked to a few market making firms about this, and they're like, that's actually not front running, because real front running means that you can basically make an arbitrage profit from kind of like crowding someone out, and that kind of like blockchain confirmation risk, like there isn't an obvious way that someone can make an arbitrage profit by doing that, right? And so while that concern is, I think it exists, it still remains to be seen how much of that is actually real and how much of that is just theoretical.
Well, I think you could do, I think the one that I had heard was, if say like you're going to be placing a market order and there's a current price, I would just instantly give you, a worse price or something like that. Take it and give you a worse price.
Yeah, that's true. So I think the market orders in terms of implementation right now, they're all kind of like being done at the exchange level, where the exchange is kind of like matching specifically orders. So there's a bit more control over market orders that kind of like an open order book DEXs don't really handle well right now.
Basically, don't do market orders on open DEXs is the lesson.
Exactly. Yeah. Overall, I think the real hindrance for DEXs is still comes down to liquidity and user experience. Because it's a lot slower trading on a DEX. You need to have an Ethereum wallet, and you have these other issues. However, I think that the reason we're bullish about DEXs is because I think people don't appreciate how much better DEXs are for the exchange, because if you look at like central exchanges, like one of the biggest vectors in terms of cost is security and custody. And so what exchanges want to do is simply be the marketplace. They just want to make money from matching, two people. It's like eBay, right? Like, just get a lot of people to come to your site to trade with one another, and you make, 10 to 20 basis points on every trade. So the last thing you want to do, in my opinion, is spend time and money worrying about security, worrying about being honeypot for hackers and other things like that. And so I think a decentralized non-custodial infrastructure ultimately will be the model, because it's simply better for the exchange, not just the user. And so that's why I think you see like folks like Binance, even though they are the most highly used exchange right now, they're working on the DEX, because for them, they probably see the DEX as a one way to continue to maintain their lead in the market.
Sure. And I guess I have to ask, this is sort of the recent trend, is that a lot of DEXs are sort of either facing regulatory challenges, or just maybe it's the fear in the market from things, and they're starting to implement some KYC AML pieces. Yep. Do you think like all DEXs are going to have to be KYC AML in the future, or is it just going to be crypto to crypto ones? Or
I think all exchanges will need to satisfy their local exchange regulations.
That's such a vague answer.
Right, but the second part of this is that I think that users will go to whichever exchange offers them the best experience. So the one thing that's really different about crypto is that you can basically trade anywhere. Crypto transfers are permissionless, and so what that means is that exchanges compete on a global basis, not on a local basis. Obviously exchanges have to satisfy the local kind of like jurisdictional requirements. So in my opinion, what that will lead to is that the decentralized exchanges that do the best will be the ones that are probably in less regulated jurisdictions.
Yeah, that's, I think a lot of people are coming to those same conclusions, and, maybe Binance DEX is onto something.
Yeah, so I think there will be a time and place for the folks that are implementing KYC and other restrictions to comply with U.S. regulatory laws. So I think that, but however, if you look at crypto generally, it's not just a U.S. market; it's a global market, and so I think that I wouldn't take the U.S. Exchange kind of like regime and try to impose that on exchanges more broadly. And so I think the question is, if let's say a Malta-based DEX is kind of like is more open, how easily can U.S. residents access it, and like how much are U.S. residents required to trade on compliant DEXs that are US based?
Well, I think this is the big question for like the BitMEXs of the world as well.
That's right. Yes, I agree. I don't think it's simply a centralized versus decentralized issue. I think it's an issue for exchanges around the world. BitMEX doesn't allow US residents to trade on their exchange. And because of that, they, I believe, are not requiring identity verification and KYC and other things like that. But as we all know, like people have VPNs and Tor, and it's pretty trivial to circumvent those geofence restrictions.
Right.
So if that's the case, and it stays, and it probably gets even more easy or trivial to access these overseas exchanges for Americans. and let's just take your Malta example. Let's just say some, Malta DEX just becomes the DEX that everybody uses because of user experience, the smallest amount of regulations. Wouldn't that drive U.S. policy to sort of lower the barrier entry if they want to compete? It's kind of like a healthy competition in that way.
Possibly. I guess like I think U.S. regulators aren't quite. I can't speak for them, but I think that they're more interested in ensuring compliance with the existing policies rather than in changing the policies themselves. However, I do think that the fact that crypto essentially is a currency that can be transacted globally does increase the ease at which people can access these overseas exchanges. So one model is if you look at what happened with online poker companies about 10 years ago, there was a big wave where people could access online gambling sites, but eventually they all shut down, not because the U.S. kind of forced them to shut down, but because the U.S. Credit card issuers would not work with those online platforms. So folks like PokerStars were getting a ton of traffic from U.S. people, about 10 years ago. But if you look at kind of fast forward to today, those platforms all don't exist. However, online gambling sites like Betfair, Paddy Power are very active in the EU, but U.S. residents are not able to transact there because a lot of them don't take U.S. credit cards. So I think the fact that crypto is kind of like transfers are globally permissionless does make accessing these international platforms easier for U.S. residents. How that'll shake out and whether that actually kind of like provides a kind of like a competitive disadvantage to U.S.-based exchanges, still remains to be seen. But I think it will be an interesting dynamic to watch in the next 5 years.
Yeah, I guess as we start wrapping it up, any recommendations for young startups trying to get into, whether it's start a fund or a crypto project, kind of like you guys were doing?
Yeah. I think so I think the one kind of like hard lesson we've learned, even outside of the whole SEC thing, is I think it's really important to focus on the problem that you're solving for folks, as opposed to being kind of like enamored with the technology. I think a lot, and to be honest, like in the very beginning when we first started CoinAlpha, we were very much captivated by the potential for smart contracts and how they can be used and how they're going to change all finance. In essence, we were kind of like focused on where the end state of the market might be in 5-10 years, but not as much on kind of like what was the value proposition that we're offering today to get people to switch. I think one of my favorite kind of like frameworks for startups is called Jobs to be Done, which is basically a framework that this professor named Clayton Christensen innovated about a couple decades ago. And basically the main thing is, I think the main quote from that is like when he was talking about like the market for drills, like electronic drills, he said people don't care about buying a 1/4-inch drill bit. They care about getting a 1/4-inch hole in a piece of wood. And so finding a way to solve for that, for what people really care about, that's not available to them today, is I think what a lot of crypto startups should be thinking about. Because it's not I think people don't use things because they're decentralized or because they're new. They use things because it solves some problem that they had that they couldn't solve before. And so, it was pretty clear after our first experiment with our blockchain-based hedge fund that, that just by putting a fund on the blockchain, we weren't solving a problem for fund managers. we were solving we were solving a problem for retail investors who couldn't access kind of like funds before, but to really make that work, we also needed to convince a lot of hedge fund managers to use that model. And the value proposition for a blockchain-based fund versus a normal fund just isn't there right now. And so, by doing HummingBot, we were, pretty careful, in the very beginning to try to focus on, what problems were we solving. We're solving for users. It was ability, because like for traders we talked to, they said, they were always seeing all these bots out there, and they always felt that they were kind of like missing out by, they were essentially getting, they wanted that edge to compete directly with other bots they're seeing and other traders that they needed help with. And for exchanges, it was a need for liquidity to compete with other exchanges. And so we think HummingBot does a better job of kind of solving those problems, and focusing on that is kind of like our main job. But just building technology for technology's sake, is probably not a good idea.
Cool.
Nice. So, if you want to shout out HummingBot and tell people where they can go if they want to learn more or get involved, please do.
So our website is hummingbot.io. So we'll be releasing a white paper in the next couple of days, and we're aiming for general availability of the bot by the end of February.
Wow, that's awesome.
Nice.
Yeah. So, and then any positive thing you can end with, saying the price is going to go up next month?
What's
your bot say? Is it?
I think that I don't trade cryptocurrencies myself, and that's mainly because I think that in terms of price, I'm kind of a purist in that perspective. I think the current price capture reflects all available information. And so,
information is so volatile.
And so I think the best way to trade is to find opportunities where you have you have almost like a risk-free chance of making money. But to do that, you need to kind of have a HummingBot. Well, have something automated, and because you're not going to catch those manually.
Sure. Awesome. But thanks for being on. This was great.
Thanks so much.
No problem. So glad to be here, and I hope I can help you or any of your other listeners.
Yeah. So this was super interesting. I hope you enjoyed the conversation too.
Me too.
So definitely reach out if you have any questions for us, or
okay.
I'll definitely try out some. I want to try out HummingBot and go look at the code. Definitely.
So there's a sign up list on our website. Try it out, and we should be up and running in a couple months. Maybe just what do you plan for the podcast? I'm curious as to kind of.
Yeah, so we just sort of started it because we realized that the one thing that no one had ever heard of us, and what's one thing that we could do to sort of have some good content pieces, and one of it is writing, so Medium articles. I love doing those. And another piece was, we thought that the space needed more. We know there's a ton of like financial or a ton of Bitcoin podcasts and things like that, but we felt like just having conversations with people that were more real and not as just like white paper-esque would be cool. Where you can sort of talk more about just everything, especially even, I came from the regulatory space, so talking a lot on some more of the regulatory issues and giving advice to some other of the projects. And obviously it's a great learning experience for us too.
Cool. It's also, just something that we enjoy doing, and why not record it and share it with the space? There's a need for it, we believe. We'll see what happens once we launch all the episodes, but
we had right now our episodes, so we had Robin Davids, he's an ICO guy who's done a bunch of them. We had Dusty Granite, he runs JST, which is they do market making in the crypto space. Then we had Michael Morrow, He runs Genesis Capital.
Okay.
And then you were this one, and then we have a Tori Adams from Consensus coming up.
Oh, cool.
So, we have like, it's awesome because the people who we reach out to are just, such high quality people in order to talk to, and they all just have such different, like, I mean, your opinion versus, Dusty, who was also a market maker, like, your opinions like couldn't be different more, you guys all have completely different opinions on, like, he thinks dexes are the, we're 10 years off from a functioning dex, and and you like dexes, so it's always it's just great hearing the different pieces of it. But then you also kind of, it's like you have completely different opinions on what's going to happen, but then you're all just like, but we're amazingly bullish on the space, which is great, like, so
I mean, I think that so actually I just read this book called The Master Switch. It came out like 10 years ago by this guy named Tim Wu, but it tracks kind of like the rise of these different like information technologies. And he starts with like telephone, radio, TV, film, and so forth. And I think my main lesson from that is that like it really takes a lot of time for any new information kind of technology to like get into the mainstream. Because like it seems pretty obvious now that radio was an innovation beyond the telegraph, but even radio took like 10 to 20 years to go from like its first, its very first kind of like iteration, which was the ability to broadcast in like a 10-mile radius, to the nationwide type of network, which actually was able to displace the telegraph. And so I think that I think a lot of us in the space kind of agree that blockchain technology is, generally a good thing. It's obviously not kind of like perfect for every use case, but there are a lot of use cases, in particular the financial ones, where it's simply better than the traditional centralized, infrastructure. So it will just take a lot of time, I think, in my opinion. And so for me, I really look at kind of like my career in blockchain as a 40-year journey. I'm
Sure.
I think I have like 40 years of my working life left before I'm completely decrepit and useless. And so I hope to kind of like see the transformation of finance using blockchain over that span of time.
So you think your whole rest of your career is all going to be blockchain oriented?
Yeah, definitely. Like blockchain plus finance.
I hope so for me too.
Equals something magical. But it's I really think it will take between 20 to 40 years for it to truly get mainstream.
Yeah, it's like it's really cool. I can't wait because you see, like, I know with myself, kind of like you were saying, you sort of get enamored with the technology and building up, like, we can completely decentralize everything. Let's go and do it. And then
I bet you 20 years is probably the average. If you look at all these different technologies between when you could say they became mainstream, you gave it a radio example, but motion pictures, I think the first one was 1895. It wasn't until the 20s that there were like, movie theaters.
Yeah, and I think it's always a mistake to like look at the very first version and say, well, this won't work. This is like, very impractical, slow. It's like poor quality, and because I think the real transformation is when a lot of like entrepreneurs and people work on it over that 20-year period, and eventually it's something which is better in all respects compared to the traditional alternatives. And so right now, like traditional databases are going to be a lot better in most things. And so I think the trick is finding the use cases that actually do make sense for blockchain and just continue to push it out and prove that there's value.
Cool. Yeah, that's
one use case at a time,
Yeah.
And slowly, I mean, the momentum will build, and everybody asks, like, well, what's the use case for this, or has there been a proven use case that was successful? And the more we get to the point as a community that we can point to more than one, then I think the mainstream will start to accept that
more than crypto.
More than yes.
So anyway, yeah, and shout out to the DeFi Telegram group, which is how I met you.
Yeah. I think it's good. I think DeFi is one of the big trends for this year, because I think like
Sure.
a lot of people don't realize how much activity currently exists on all these decentralized financial applications. Maker, Compound, DYDX.
I think like what 99% of it is Maker. Whenever you look at those trackers, like DAI is just enormous at this point.
Yeah. But I think that even this year with what you guys are doing, SEP protocol, we're pretty good friends with the folks at UMA, which is a new kind of a new kind of a synthetic risk transfer protocol.
So that's going back to your CDO days, right?
So a lot of what CDOs were essentially regulatory and rated agency arbitrage. However, I think that like kind of putting on my jobs to be done hat, I think that allowing people who are kind of like in other countries who can access like a synthetic S&P 500 index, or be able to take both a long and short view, even on a small scale, on tokens is attractive. And so I think that I'd rather focus on like what is a problem that people are solving that's not available to them using a centralized alternative, than to kind of like to just say, oh, we're creating CDOs in blockchain, or loans in the blockchain, or funds in the blockchain. I think that like those like general X for Y analogies, like they simply don't work, because like it's more about what problem you're solving, and because like CDOs at large, that problem isn't going to get solved on the blockchain more so than it did in the past. However, providing someone with access to financial products who couldn't otherwise access them because they live in Venezuela or Guatemala, is definitely a problem we're solving.
But I think that's one of the pieces that it's just so far away due to the regulations. You have
yeah. Well, I think like regulations definitely play a part, but I think for that individual, let's say you're in kind of like in some third world country, like they're not. It's not that person is unable to access because of regulations. In theory, if a let's say a Venezuela-based company creates a smart contract-based way for people to access, call it like to create and access S&P 500 index products in Venezuela, they're all within the rights to do so.
But that's what I mean. Like, you say like a Venezuelan-based company, and that's like the issue. Like, it's obviously not a U.S.-based company who's doing,
Well, I think the U.S. companies can do it. It's probably more of a gray area and probably carries more legal risk than a Venezuelan one.
Right.
But I think ultimately, those like regulation-based issues will get resolved if the products are solving a compelling need. So I think that the question to me is the more important question is, do people in Venezuela
want S&P 500 tokens
500, or do they want to short or go long other things that are enabled by smart contracts, not whether it's regulatory possible or not.
Cool. Okay, well, we'll let you go.
But anyway, it's great. I'm happy to continue this conversation later on. But also, I also want to say I think what you guys are doing is great. I took a brief look at what you wrote in Medium and other things, and if there's any way I can help, kind of given my, I guess, like derivative structuring experience. Just
definitely. We're working on an Oracle piece next. Trying to decentralize that.
Okay. Yeah, actually, on that, we used to use Oracleize for our fund, and we found that it was pretty unreliable. So I think if we were to do it again, we would write our own Oracle, because I think people kind of like we found that actually very few people cared about how trustworthy the Oracle was. They cared more about performance of the Oracle, like how 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 reliably can you get data into a smart contract, in a certain amount of time.
Yeah, and that's it's a really, the Oracle question is always really tough as far as doing it properly. That some people rely on, say, like the Augur prediction markets. That's like the proof of stake version of sort of one that's, you can sort of say is fully decentralized, but then that's really slow and limited. So it's gonna be an issue. So
yeah. And you may also want to look at what UMA is doing. I think they're
they haven't released much. There's been
Oh, okay. Yeah. So, So I think, I think they have a blog post, but I've,
that's like about it. Is a blog post.
Oh, yeah. So I know them pretty well, and I think that one of the main innovations they're doing is creating an incentive mechanism for essentially the Oracle providers to be truthful.
Yeah, it's always really tough. We've been playing around with this problem because, like, derivatives in general are sort of throwing a giant wrench in all of the incentive mechanisms, because even like with the Ethereum blockchain, and there's like, what's the cost to do a 51% attack on Ether?
Right.
You can theoretically take out a derivatives contract shorting that amount, or that you can make more, and it just ruins every incentive mechanism in blockchain.
And so I don't want to steal the thunder because I know they haven't published it yet, but I think a lot of the thought that they put behind their protocol is around that kind of like, how do you prevent a 51% attack from the Oracle provider?
Yeah, I mean, no, it's just not even the Oracle provider, like a competitor, even. Like if Apple thought that Ethereum was a competitor to it, there's not really a whole lot to prevent us from Apple ruining our network. Like with $1 trillion in the bank, they can really just throw money, especially once we're proof of stake. It'll be 10 seconds and it's gone. So it's always really weird problems once you start introducing these like off-chain incentives or disincentives.
I think it's true. I think there's like I think that the incentive won't be there. It's kind of like with Bitcoin, like it's any bank could have either killed Bitcoin or just or kind of like, or just like taken it over completely in the last 10 years. But like it was never big enough for them to devote the resources to it.
Right.
And now it's probably so big that that doing so would be kind of like enormously costly. And so I think a lot of people kind of I would say I personally bank on that as a as kind of like the defense, but
well, that's why it's always really tough, structuring it, like, whether UMA or us, with you're trying to structure your Oracle security, and it's like, well, if you assume that you're just going to fly under the radar and no one's going to care until you get to this point, then it works. But if if they attack you anytime before you're this big, then it's theoretically insecure. So it's I'm curious to see their analysis. So if you want to make an introduction, definitely. I reached out to them, but I couldn't.
I'm happy to make an intro. I think they're especially looking for like people who may want to build on top of their platform or market make for them. So I'm happy to make an intro.
Yeah, that's the thing, because like we have our own contracts for derivatives, and we think that's the way to go. But if there's any other protocols that have pieces that we can use, we definitely just want to keep it using the best products that are available to, that don't limit you in any way. So,
well, like your original point, like it's not about competition. It's about what's it? The rising tide raises all ships. So.
Yeah, I know. I firmly believe that, because I mean, if you look at like other industries like internet, even radio, all the other ones, like it's about a small band of people who are really believe in the future of it and work together to make it happen and expand the pie for everyone. So it's I think obviously the crypto faced a lot of headwinds last year, but I as I said, I believe over the next 20 to 40 years that it's going to dramatically transform finance, and I want to be there to see it. Hopefully, we'll all be there to see it.
Yes.
40 years in the future, we'll be running the Goldman Sachs of the world.
Yes.
No, but thanks. If you ever come back out to DC, hopefully you don't under the similar circumstances, but
Right.
Definitely let us know. We'll be here.
All right, we'll do.
All right. It was great talking to you,
All right, Michael, Nicholas. Great talking to you guys too.
You too.
Bye.